Good afternoon, everybody. My name is Sean Lee from FXWW, and welcome to the part 2 of a webinar on professional opportunities in the foreign exchange market. First of all, the usual disclaimer: FXWW provides business services to traders, and none of what I say is in any way intended to be financial advice or advice to trade. So last week, we had a look at the opportunities available in the retail market, and we looked at, first of all, providing strategies to retail clients, trade lead, trade follow programs, and managed accounts. The only one of these which required licensing, even though it is recommended in most cases, but to date, the only one that requires licensing in most regions is the managed account section. Unfortunately, the webinar last week I felt was a bit like a radio broadcast, and it was just me spouting information, and there's not a lot I can do about that, I'm afraid. Today may be very similar, so I'll warn you in advance. There's not much. It's not as if I can show you charts and talk through potential trades, etc. This is, unfortunately, it's just me trying to provide some information as best I can. The webinar is slated to go for 45 minutes. With questions, please. Can you just hang on? Okay, let me try this again. With questions, can you just hang on until the end? The webinar is slated to go for 45 minutes. It probably won't go for that long. And so we should have a bit of time for general questions at the end. And if you have specific questions, then you can send them to me directly. I'll give you my email at the end. So as I said, last week we looked at retail opportunities. Today we're going to look at opportunities available in the professional market. And first of all, I'm going to look at careers. So if you're a 63-year-old grandfather, the likelihood of you getting a trainee job in the market is the same as the likelihood of you getting a trainee job in any industry, probably pretty low. Unless you have some incredible skill to offer to a hedge fund, it's probably unlikely that you are going to get a job. So trainees, generally speaking, banks and hedge funds will train graduates. Obviously in my day, back in when I started, 1986, I came out of college, and there were 1,000 banks around the world, all recruiting maybe 20 to 30 trainees every year. These days, you've probably got 50 banks around the world who are training people, and they may be only training 3 or 4. So it's a very, very difficult place to get in. But in the main, if you want to get a traineeship, statistics and mathematics are your best chance. I did some research with my friends. Here, I'll show you the link here. These guys, eFinancial Careers. We did a little bit of research into what types of graduates were generally recruited, and it was almost overwhelmingly statistics and mathematics. This is it's the way the market has been tending, rather than recruiting traders as such and looking for people who had the the psychological makeup to be a trader. Banks and hedge funds have been looking more towards the quants, people who can build models, that are going to trend following models, whatever types of models you can think of. So basically the banks and hedge funds have been heading in the same direction, and there's nothing we really can do about it. So if you're looking for a job and you're thinking and wondering what you should be studying, I would suggest that mathematics and statistics. So you can go to these types of websites. This one is eFinancial Careers. I'm sure there are others. And look at all you can do is look for trainee jobs here for these guys, for instance, the foreign exchange, FX and money markets. And you go for trading roles. Look, I'm just clicking here. They've got 34 jobs, maybe from junior prop quant trader. There you go. So there's going to be a lot of that. So that's your first place to start. If you're simply looking for a job, is study mathematics and statistics. Banks and hedge funds are both the same. Hedge funds will not train as many juniors as the banks do. So unless you know somebody, it's normally somebody's son who gets a role in the hedge fund as a trainee. So unless you know somebody, your best chances are by far to apply directly to banks. And look in these sort of portals for jobs. Not much more I can tell you on the jobs front. It is pretty tight. If you want a career in trading, you're really going to have to start out on your own. You're going to have to, like we spoke about last week, build up a track record. So I'll move on. Presuming that you cannot get a role here in one of the banks and you're trouble getting started in a career, you would have to start, like we spoke about last week, either as a strategist or a trade leader or an account manager, building up a track record. Once you have that, let me go back here. Once you have that track record established, you are going to there's two things you're going to require. One, you're going to need to become licensed, and two, you are going to need some marketing material. So let's look firstly at a typical. That's a horrible color. A typical piece of marketing material. It's going to look something like this. This is called your one pager. It is going to show a little bit. Let me see if I can increase this. A little bit about who you are. Trader Bob. Just background details like you can see there. Then, and this can become very, very difficult to do, even though it sounds easy. In I don't know how many words that is, 100, 150 words. Explain what you do. And so many traders have difficulty doing this. Even those who have a typical quantitative approach to trading and they've got models, you still need to be able to, in a few sentences, explain what you do. And I've known people who've taken 6 to 8 weeks trying just to write that 100 to 150 words. So it's not as easy as it seems. But you do your background details. Your investment approach. Then you show your performance here and. Then some analysis. Look at this. There's software out there which does all of this for you, and you're going to need some sort of material. Just like that. Let me show you. Then there's another one, a sort of a longer one. And this is like a two-page report, which again covers all of the areas I just talked about. So, if you wish to start promoting yourself in the professional world, you are going to need, something like this. If you, sorry, people are talking to me. Stop talking to me. You distract me. So you get something like this. If you don't have the software to do it yourself, there's there are services who'll do it for you, and it costs you like $100 a month or whatever. You need this, and you need to be licensed. So last week we spoke about licensing. It's not necessarily essential that you're licensed if in the retail space, and some places you can get away with it. Once you move up into the institutional world, you must be licensed. There is two ways about it. You're becoming a serious trader now, and whatever jurisdiction you're in, you're going to have to go and get a basic license. Like we spoke about last week, internationally, the simplest license to get is called a CTA, a Commodity Trading Advisor, issued by the NFA, and anybody anywhere in the globe can apply for and generally get this license. It's not particularly hard. It's an exam, an online exam. Cost you maybe $800 to do, a couple of weeks study. You should be able to pass this if you have been around the markets for a while. If not, then just study a bit. It's not rocket science. It's financial market stuff. So that's called the CTA, Commodity Trading Advisor, issued by the NFA, And if you're serious about getting making some progress in the institutional world, you should go and at least get that. So I'm presuming you are licensed, you've got some marketing material, and now you're ready to go and promote yourself to primarily hedge funds. Now, the whole area of asset allocation has changed just out of sight, I would say, in the last 5 years. So when I started this business back in about 2004, most traders initially got their start from one of the banks. So you would go to a bank, you would say, this is who I am, this is my background, you've got this professional material here, you probably have more, you're portraying yourself as the next George Soros, you're fully licensed, etc., etc., and the bank said, okay, I like what I see, here's $10 million. So they give you a $10 million trading allocation, which you can leverage probably 3 to 5 times, and you start trading with this money on their platform. And with that, you build up a track record. They promote you to their client base, and that's how you would raise more money. So that's how today's hedge funds, most of them started out with an allocation from a friendly bank. Now, remembering most of the today's traders, today's hedge funds were in the foreign exchange space started off as interbank traders. So they had a lot of relationships in the banks, and that's how they got started. The global financial crisis changed all of that. The banks took massive hits, lost vast amounts of money, and they were seen to be gambling with clients' funds. So there were regulations put in all around the world, really, and it is very, very, very difficult now for a bank to give proprietary trading capital to an outside trader, even if they're just trying to get them started on the business front. Yeah, it's just almost impossible for them to do. So whereas up until, say, 2007, the banks had been the main gatekeepers, if you like, of investment funds into the foreign exchange space, since then that mantle has moved across to the big hedge funds. So, the really big guys now managing 10 to 15, maybe $20 billion under management. Now, there's no way you can manage, well, I say no way. It's very, very, I would say no way that one individual manager can manage $20 billion in the foreign exchange space. It's just, it's just too much money. Even if you deleverage, you're still going to move the market too far every time you try to trade. So the way around this is to have lots of different strategies. So the super big hedge funds, if they've got $20 billion, now they can start to invest funds in other strategies. So you come along, you're a startup trader, and you want a $10 or $20 million allocation to get you started. So, okay, one, you can, you cannot go to the banks anymore. It's pretty much a waste of time going to the bank and trying to get them to give you some money because their hands are tied. They simply can't. Now, whilst they can introduce you to, potential investors, yeah, that's certainly an avenue that you can go down. But yeah, once again, the bank's hands are tied much tighter than they used to be. The easiest avenue, the easiest way to get started is to go along here, you're fully licensed, go along with your marketing material, and you start introducing yourself to big hedge funds. Now, these guys aren't stupid, so rather than, they know that they can get you started. You could be, the next Professional Traders Limited, the next gun trader on the planet, that you will in time develop into a $5 to $10 billion hedge fund dominating the market. So they love you to bits. They say, okay, I'll give you $20 million to get you started. The terms are, 1% management fee. So that gives you, a couple of $100,000 every year to run your business, and a percentage of profits. Be that I'm guessing here, 10 to 15% of profits. But that's not all. They will want to take either directly an equity stake in your business or possibly have an option on an equity stake in your business. And I'm talking about a 50% equity stake in your business. So if they see that you are a talented trader and you look to have what it takes, that is going to be the offer they will make you. This is it's a tough one for a lot of traders, especially starting out. You think you have what it takes to build a big trading business, and this guy up front wants 50% of it. That's a pretty hard pill to swallow. But think of the other side. You're given a salary for 1-2 years, which will help you to survive as you're building your business. The contacts, well, first of all, the services that the hedge fund can give you. All this marketing, all the material, all further licensing, legal advice, accounting advice. They've done it all before, so many times, and you've never done it. You don't know who to go to, and so you could be spending, $300-400 grand a year on all of these services, rather than being paid and getting them all for free. Okay, I know you've given away 50% of the business, but it's where you're going to struggle is early on. It's just a very hard thing to get started, get a hedge fund started from scratch. So it is you really do need to think about this. Selling 50% of your business early on to make your life a lot easier is certainly worth a lot of consideration. And if you're any good, the amounts, once the industry works something like this, there are the same sort of people generally allocate, the same type of person, if you like, funds, high net worth individuals, family offices, there's lots of different sectors who will allocate, but they, generally speaking, have rules. So if you turn up as a promising trader but just managing your own funds, even if they want to give you money, they cannot. Pension funds, investment funds, they usually can't. They will have rules determined, how much money do you have under management? What percentage of the total that you have under management can they allocate to you? So in the main, once you get past $100 million, you're off and running. You hop on a plane to Switzerland, as soon as a lot of these funds, they will have a minimum of $10 million which they can allocate to you. But there's also a maximum that 10% of your total assets under management, they cannot allocate any more than 10% of your total. So the minimum is $10 million. So they cannot allocate to you until you get to 100 million. But if you get to 100 million, you get on a plane, go to Zurich, and you'll probably walk out with 200 or 300 million under management. I'm simplifying it a bit, but the hedge fund, if you're owned by the hedge fund, he provides the introductions, he provides all the initial capital, he can get you over 200, over the 100 million pretty easily. So in order to build a hedge fund, the easiest way now is to sell 50% of your business to an existing hedge fund, and that's just simply the way the market is now. But obviously you've got a choice. You can decide, no, you don't want to go down that route. You want to be master of your own destiny. You've got some capital to get yourself started, and you can invest in your business. It is possible. It is possible to build your own business. Difficult, but possible. You will need, as I said, the marketing material we looked at here. You will need to be fully licensed, like we mentioned earlier. You will need a third-party marketing agent, unless you know everyone in the market, like in all the different sectors and all the different financial centers. Which, let's face it, you don't. You will. So the best thing you can do is you go to London, you go to Chicago, you go to New York, you go to Singapore, and you hire a third-party marketing agent. they know all of the people who will allocate to managers like you, traders like you, and in return, they get a percentage of all fees that they generate. So let's say, for argument's sake, you are looking for what's called 2 and 20, a 2% management fee and 20% of profits. It is probably likely that the marketing agent will want about 20% of those fees. So he will take 1/5 of your management fee, and he will take 1/5 of commissions. It may seem worthwhile. It can get quite annoying later in your career when you are, managing huge amounts of money and making huge amounts of money, and you're paying out what seems like a fortune to some guy who's on a golf course somewhere because he just gave you an introduction. Look, at nothing I can't help you there. That's just the nature of the business. If you don't have the contacts, it's almost impossible to get to meet and the people who will possibly allocate to you. So moving back then to so the third-party marketing agent, that's what you need. And yes, you need also a relationship with a bank or a broker. Now we spoke about this a little earlier. The banks, they cannot allocate to you directly anymore. It's just not possible. But what they will do is if you agree to what's known as a prime brokerage relationship with the bank. So you say, in the main, you're going to clear all of your business through this particular bank, and you pay a fee, like say it's $7 per million turnover or $5 per million turnover, depends on the size of trader you are. You sign a prime brokerage agreement with the bank. The bank, in turn, will start forwarding this marketing material and providing recommendations to potential investors. So, in my experience, it hasn't been hugely successful. The banks, they're cautious. It's just in their nature to be very cautious. So they are worried. You may have the best performance imaginable and hardly ever had any drawdowns, and you just look great. But the bank is more worried about his reputation if he introduces a losing trader to an investor, rather than the possible brownie points, if you like, he will gain by introducing a successful trader to an investor. I hope that makes sense. So banks and brokers, they will promise that they do this, that, and the other, introduce you to investors, etc., etc. But very, very, very cautious. They will do it in more of these roadshow type events where they invite 10 emerging managers, and you may be one of these emerging managers or emerging traders. They fly you to Zurich, and they have a fancy hotels room booked, and they invite some investors in, give a speech, and then introduce you as part of a group to investors. So they're much more likely to do that rather than to individually say, okay, to an investor they should invest in Professional Traders Limited, because they're just simply too cautious to do that. So recapping again, you've decided to go on your own. You need full marketing material. You need to be licensed. You need a relationship with a bank and a broker or a broker, and you need to be willing to travel a lot. Even if the third-party marketing agent can introduce you to prospective clients, you're going to be on planes. You'll be flying around the globe, introducing yourself to prospective investors. And it's, you don't walk in the door and the investor says, "Oh, I love you to bits. Here's $50 million." No, you generally have to meet with them 3, 4, 5 times. They hem and they haw and they think about it, and 6 to 9 months later they come back and give you a $2 million allocation. It's a tough road, it's just not. It is not easy, I suppose if it was easy there'd be a lot more people doing it. So that's why the big established hedge funds are in such a dominant position. They're and okay. There's one little bit I forgot about here. You're also going to find, particularly in New York and Chicago, you will find smaller funds who will try and buy a controlling interest in you early on. And the reason they want to buy a controlling interest in you is that they have relationships with the bigger hedge funds, and then they go and sell on their share to the big hedge fund at a greatly increased profit. So be careful. You'll see, I don't know whether you've come across this, but it's becoming more prevalent online. The guys promising you these funds, investment funds, promising you the everything, promising you the world. You're going to be, the next George Soros very quickly. They will invest money in you and make you look good and blah blah blah. They're after their own interest, so they will look to make a small investment in you and sell out as quickly as they can to some of the bigger hedge funds. So I think it's worthwhile if you are a good enough trader, and if you think you have what it takes to be, develop yourself into a manager, then you go and start a conversation with some of these bigger hedge funds. I know it's not easy to get into them, but if you push hard enough and keep, if you have decent material, marketing material, and you can send it to them on a regular basis, then eventually you will get you get an interview with somebody. So that's building your own sort of manager type. You're becoming a money manager, if you like, in this scenario. There's also, of course, the possibility of going to work for one of these hedge funds as a trader, and if you like, an outsourced trader. In this case, you become salaried, if you like. So back to the old bank model, the way most of us started out in our careers. We worked for a bank. We got paid a salary and a set salary, and at the end of the year, if there was a certain amount of profit made, we got a share in that profit. And the present day, the big hedge funds, they offer exactly the same deal. Now you need to be a specialist in something. So there's a prop trader and there's if you like, an intraday trader, and both of these can operate virtually. So you could be a specialist intraday trader in, euro sterling, and you trade exclusively during London hours. You will probably find that if you're good at this, there is a job for you somewhere, and most probably with one of the the big hedge funds. As I said, they've got $20 billion to manage, so they can afford to employ 100 dealers, if you like. So dealers and traders. I make that difference. The dealer is the guy who's sitting there intraday, just making a market, trading off the seat of his pants, just, and generally he will go home at the end of the day without a position. He will be square. And he will generally specialize in one currency. So if that's you, and you have a track record that proves you have that ability, then there is more than likely one of about sort of 12, 14 large hedge funds around the world who may give you a job doing that for them, salaried and on a percentage of profits. Now, you don't necessarily get a percentage of the profits that you make. That's the sort of slight drawback here. You could have a magnificent year and earn vast amounts. Of course, they're going to try and keep you, so they'll want to keep you well remunerated. But if every other dealer on the desk lost money and there was no net profit, there is nothing to pay you with under this model. So that is the slight drawback, if you like. But it's going to suit a lot of people. It will suit people who have no interest in hopping on planes and going to meet investors and being constantly disappointed. It is a decent possibility for for a talented interbank or intraday trader. And similarly, they will also employ prop traders. So apart from, they've got two choices as a hedge fund. They can either buy into like take a 50% share in a prop trading business, or they can employ prop traders. And that's a slightly different model. Once again, you're salaried, and you manage their money. You manage the money for the hedge fund. So I think that pretty much covers all of the possibilities. So I'll recap again. I mean, I know it hasn't taken us the full time, but I'll recap again. Generally speaking, and I know this is going to sound terribly sexist and ageist, but the opportunities are mainly for young males. Don't be suing me for saying that. It's just the fact, just the way it is. It has always been that way in the financial markets. You get employed generally on a dealing desk, and they're a banker or a hedge fund as a graduate, 22-year-old male graduate out of college, and they're the guys who are generally hired. Now that doesn't mean if you're a 45-year-old female with an excellent trading business that you can't sell it to a hedge fund. Of course you can. Of course you can. But there are more opportunities. Simply, it's just the fact of life. There are more opportunities for young, aggressively trading males straight out of a mathematics and statistics degree. Now, if you can't get a job directly in a bank or a hedge fund, then, like we spoke about last week, establish a track record, either as a strategist, but preferably managing money. Start out with your own money, and build a consistent track record. Show people what you can do, and hopefully start managing money for third parties in the retail space. Showing a bit of success there, you probably have a 2-year track record, I'm presuming. At that stage, you go and get licensed. Minimum CTA license with the NFA, Commodity Trading Advisor, minimum. Let's get yourself some nice marketing material, something like this, with the usual analysis, and you start advertising your wares. You promote yourself, one to hedge funds, and secondly to banks, but mainly to hedge funds. I think that's just simply the easiest way to go. Try and avoid these smaller investment funds who are, giving you the spiel that they're getting you started, but they don't do much and want a lot in return. So make the effort, promote yourself, get a good track record, and go directly to hedge funds. Either selling 50% of your business, or looking for a job. Simply looking for a job at one of them. And then you make a fortune, retire at 35, blah blah. It doesn't happen very often, but it has happened to some lucky ones. So that's pretty much it. As I said, we're a little bit early, but I knew that was going to be the case. So if you've got any questions that are sort of general questions, fire away. Otherwise, I'll put up my email address at the end, and you can send me questions directly if they're more specific to your case. Okay, go. Yeah, thanks, Jano. I knew it was going to be a bit like a broadcast. I'm sorry about that. And I think next time I'll stick to something more where I can show some charts and stuff. And look at your earlier question, Jano, regarding the 2% commission. No, the normal fees in the market are 2 and 20. 2% is what's called a management fee. So if you're managing $1 million, you get 20% management fee, and the 20% commission is new profit. So if you have $1 million you're managing and you make 100,000 profit on that, you get 20% of the 100,000, which is 20%, which is 20,000. So 2 and 20, which is the market standard, 2% is management fee, 20% is commission. So that's not a broker's fee. Yes, and the high watermark, somebody's asking about. Yes, always. You must. It's commissions on new profits. So you must, if you lose money, you must make that money back before you start getting paid. No, Chuck, I have never worked for a hedge fund. I spent 3 years after I left. I used to work for Deutsche. I left and tried to set up my own hedge fund. Had reasonable success trading for myself. But once I went and started trying to market myself to, professional investors, they were talking language I didn't understand. I come from a treasury background. They were talking about drawdowns, Sharpe ratios, AUMs, and I went, blah, whatever. I had no idea what they were talking about. So that is really the reason I set up FXWW in the first place, was to help ex-interbank traders who wanted to become hedge funds, and we're going to make the same mistakes that I did. So Sharif, you're asking here about managing your own money. Look, it's a good question. You need to notionalize your capital. So if you go into if you're applying to a hedge fund and you're saying, I've got a $10,000 trading account and I want a job with you trading a $20 million trading account. I mean, it's just, there is no obvious relationship there. It's just, So what you need to do is treat the money in when you're trying to set up a track record, treat the money in your account as money at risk. So in other words, it's just like any business. You put your money in that you can afford to lose. Now, if that amount is, say, $10,000, you treat the size of your account. Generally, I use a 10 to 1 ratio. You say 10% of your total assets are at risk. So if there's $10,000 in your account, you notionalize your account to 100,000. I hope that makes sense. So if you're trading then 2 lots, you're not using 20 to 1 leverage, you're using 2 to 1 leverage. And your P&L, your profit swings, like here, your plus 1.25% in April or whatever, that is based on the 100,000, not on the 10,000, because that is it's just unrealistic. Do you know what I mean? So I hope that makes sense. If you have any specific questions on it, just send me an email. I'll just hang on. I'll just put my email address up here. But yeah, it's important to notionalize that amount, because there is no it's silly to compare trading a $10,000 account on your own to trading $20 million for a hedge fund. Yes, the webinar is recorded and will be up. No, Dinesh, I do not offer third-party marketing services and advice for. No, look, I can help you, but it's not what I do actually. So the quick answer is no, but I can introduce you to people who will help you there. Starting capital for a hedge fund is 10 million. I would say very minimum, Jano. Really, up until you get to 100 million, you're not really a hedge fund in my view. You're just you're an emerging fund. Once you get over 100 million, I think then you're a hedge fund. So have I missed any questions? Asset classes, somebody asked me. Only FX. Sorry, I'm just I'm a dinosaur. I don't like anything else, so I'm only FX. And yes, a 2-year track record minimum, I would say, Jano. But 2 years is enough. If you have a 2-year track record and it shows a consistent performance, then I think you can proudly walk to anybody and say. This is what I have done in the last 2 years. So you can hold your head up for sure. Okay, I think I'm pretty much finished. Thanks all for tuning in. Webinar is recorded, so if you can't sleep some night, this should send you to sleep. Turn it on. And thanks for listening. And send me an email, Sean@fxww.com, if you've got any specific questions specific to yourself. And good luck with your trading. Hope it all goes well. Cheers.